It is Monday, September 28th, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was no jiu-jitsu, get your ass kicked at jiu-jitsu Monday. I'm still on the mend from a little tumble that I took on Thursday, where I cut the shit out of my ankle. So it's one of those high traffic areas in jiu-jitsu, and so I'm having to, well, as if anything on your body isn't a high traffic area in jiu-jitsu. But anyway, you know, that and a couple other injuries that I sustained in the fall has been kind of preventing me from rolling. And I hate it. I really do. I hate any time missed off of the mats. And you know, another thing that it gets me on is that I as I feel better and better on the mat, I tend to want to spend even more time at the gym and even more time at the gym. And I think at the peak I got up to about 5 days at the gym, and then I started getting injuries. And that's one of those risks that you take in jiu-jitsu, is that you'll get to a point where you're not allowing your body to heal well enough, you know, and then you get an injury, and then of course, rather than taking the time off and fully mending, you do stupid things like just playing drill dummy for one of your partners, and of course it'll feel great. It'll feel okay until you go and you try and test it, and then you get hurt even more. And it was funny, I kind of explained this to one of the people that I train with, and she like completed the sentence for me. She's just like, yeah, you know, it'll be fine until it's not. and I said it'll be fine, and she said right up until it's not. And it's like, yep, that's pretty much how it goes. And those of you that do train, you know exactly what I'm talking about. Where, you know, you'll feel like you can get through the cardio okay. It might hurt just a little bit while you're doing the drills, but then you'll feel okay. You know, you'll be like, oh yeah, you know, I could push this just a little further. You know, just a little further, and just a little. Oh fuck, that hurts. Oh, I just injured myself even worse. And it's this thing that you go through where you have to go through it a couple times, and then you figure it out. It's that I have to allow my body to heal. I can do other things. There are other training methodologies and methods that you can use that won't impact it the same way. And it is good to continue to do what you can, but don't go back to trying. Don't immediately go back to trying to roll. I mean, you're just going to set yourself up for a longer duration away from the mat later on. You know, either by injuring yourself even worse, or even worse than that, being laid up for surgery because you never let it heal right every single time you got injured. And you know, I understand the drive to it. You know, I really do. When you get really deep into your jiu-jitsu or any practice, you know, the temptation to constantly push it, regardless of what else you're going through, it's there, and you have to be wary of it. You know, I mean, I've constantly battled with it with myself, that I'll push myself right up to the point of injury, and even past that if I'm feeling especially frisky in the situation. And it's not a good habit to get into. You know, you gotta learn that the body does have some limitations, and even though you might have to reach for them, when you do catch up to them, it can be quite painful. So you want to listen to your body. You know, if it's too tight, if it's hurting because you've taken a significant impact or something like that, you know, you got to take your time to recover. Anyway, let's go ahead and throw down with some music. I know that's really brief, but I did stay around to observed class very closely, and I really wanted to get in. I mean, it's like a magnet, just drawing me in, but I resisted, and as much pain and guilt as I felt for that, I did resist, and hopefully it'll mean that I get to heal up quicker and then get the fuck back on that map. Anyway, let's go ahead and throw down with some music. And we're going to start with body count. And this seems appropriate given what we've been talking about so far. And 99 Problems. First Dance here on Coin Metal. And that was Slipknot with the Negative One. And speaking of negative ones, I got a couple articles here in the old browser, and I'm waiting for one of them to pop up here. I don't think this is actually what we were going to get into today, though. No, that's not it. It's something else that I had open. Here we go. This is all about the negatives in your portfolio when something like this happens. Okay, and this is on news.bitcoin.com, and this is by Terrence Zimwara. So yes, penis. DeFi token exposed as pump and dump scam in leaked Telegram chat. A leaked Telegram discussion by 50 so-called crypto influencers has exposed the extraordinary steps they take in order to profit on the back of unsuspecting DeFi investors. According to a leaked screenshot of the chat, an elaborate plan to defraud DeFi investors using the worthless $few tokens, FEW, had been hatched. Few tokens would be airdropped to some of the influencers who in turn promoted these to unsuspecting followers on Twitter. Once the new flash mob project gained traction, members of this conspiracy planned to sell the quote airdropped tokens to DeFi investors and thus make a profit in the process. According to a report by Box Mining, the plotters were attempting to capitalize on the current DeFi hype after missing out on the meme airdrop. However, it appears the plot collapsed after a screenshot of the alleged discussion began circulating on social media. On Twitter, some users reacted angrily to the revelations and accused some of the prominent names in the DeFi space of being, quote, scammers. Let's see, here's a tweet. It says, and this is by Tarek2101. I asked him a question and he blocked me, but I'm glad the truth is revealed. So-called crypto influencers like him should be investigated, and no one should trust or take any advice from him. And I guess that's Anthony Sassano, whoever that is. One of the exposed plotters, Anthony Sassano, co-founder of ETHHub.io and a self-proclaimed DeFi educator, has since issued an apology for his role in the scheme. In the screenshot, Sassano appears to tell fellow plotters that, quote, we need people to dump on. Sassano has been roundly condemned for his role in the botched scam, as well as for his attempts to cast his comments as a joke. However, writing on Twitter, Sassano strikes a more conciliatory tone as he apologized, quote, I know for some the I was just joking defense is a weak one, and I totally understand why people are skeptical of it. I sometimes forget that text-based humor does not translate at all and can very easily be misinterpreted. I will be more cognizant of this going forward. Bullshit. It's more like he caught me with my pants down and now I'm trying to wiggle my way out of it. Sassano insists that he is not, quote, here to dump on or scam anyone. Instead, he wants to, quote, educate and grow the adoption of Ethereum and DeFi, which will always be his number one goal. While Sassano says he will try to rebuild his tarnished image, some Twitter users are skeptical. One user, the Crypto Detective, is not particularly sanguine about this show of remorse. Reminding Sassano of his past deeds, the Crypto Detective says, quote, will be hard to earn respect now, mate. Shield Yam at the top, promoted safe at 4.5k, and now, quote, need to dump on someone. Hope you can change. A PR tweet isn't going to help. We'll see your next actions. After offering the apology, Sassano reportedly burned the tokens, as did Alex Masmej, another influencer exposed in the leaked screenshot. Just like Sassano, Masmej tries to trivialize the issue, saying, quote, no harm was done as the token was never listed. However, the box mining report suggests that, quote, some people actually ended up buying few tokens because of the influencer's promotional posts on Twitter. It adds that others, knowing full well that the token is not listed on any exchange, quote, tried to profit off of the hype by listing fake few trading pairs on Uniswap in an effort to get some members to trade. The exposure of the few joke highlights some of the risks facing DeFi investors, which also include exit scams. However, the apparent participation of influential individuals in well-orchestrated pump-and-dump schemes like few adds to the worries about the DeFi boom. Regulators eager to curtail the growth of the crypto space will likely point to such scams when justifying any future interventions. Yeah, you know what? It doesn't matter. It doesn't matter. People are still going to get into the shit, and this is something that I've been paying attention to, and it seems like people want some risk, and they're willing to endure possible Ponzi schemes in order to possibly be rewarded for such foolhardy investments. That's just people seeking ROI, return on investment. Now, you can hate it, you can not like it, you can see people getting burned and not like that. That's fine. Don't invest in that shit. When you start hearing familiar claims of, oh, you're going to make millions of dollars off of this, oh, it's going to the moon, pay attention to what the project is, what the project does. It is important that your project has a use case, because that determines whether or not it's got a future. And it bothers me that people entering into this space are going straight into the DeFi pool, trying to take advantage of what excitement there is about that, about DeFi. But if you look at the nature of these things and you pay attention to the fact that they are in fact not regulated, it's because the amount of money being spent in it isn't really all that much. I mean, it's maybe a couple $100 million, maybe. But the fact of the matter is that a lot of these projects don't have real use cases. I mean, you look at stablecoins. They have a use case. It's not a good one, but it is a use case. Whereas a lot of these DeFi projects, I'm reading it and I'm like, well, what the fuck is this thing? It's like it'll go up in value if the T Bitcoin that it's collateralized by goes up in value. I just, anything that's that complicated, 9 times out of 10 they are trying to work you. And it's because not everybody's going to sit there and read that shit. And if they really did read it and really did understand it, they would find out it's a bunch of gibberish. You know, a bunch of contradictory claims. Right here. But, yeah. I wanted to get on from that. And, I did find another little bit from there. Let's see, here we go. And this is on boxmining.com. This is a follow-up off of that DeFi thing. Newsletter 9, this is by Michael, so yes, penis. And this was September 26th, 2020. Week in review. Few tried to profit off of backs of others. Around 50 notable names in the crypto Twitter space were caught red-handed for essentially orchestrating a pump-and-dump scheme. This started when they apparently missed out on the meme airdrop and so decided to, quote, redeem themselves at the expense of others. Their plan, known as the Experiment, was to create a new flash mob project called Few. There was not much of a plan in terms of launching the project or what it was all about, but there was a clear intent to airdrop the token to their fellow members who would promote it on Twitter or pump up the price of Few. Afterward, the members would proceed to sell their airdrop tokens and walk away with a few extra bucks in their pocket. However, someone leaked screenshots of the private Telegram discussion in the public. Needless to say, the public went into an angry frenzy, with Anthony Sassano getting the brunt of the anger as screenshots showed him saying their project needed, quote, people to dump on. Members of the group quickly came to say, quote, the experiment was a joke. When the public wasn't satisfied with that explanation, they also claimed they were going to donate all of the profits from the project. Sassano eventually admitted his initial explanation that it was a joke was weak and apologized. However, he maintains that he did not think Few was a scam since he saw some notable influencers in the Telegram. He also burned his Few to assure the public he's not going to dump the tokens on them. Other members, such as Alex Masmej, also insisted no harm was actually done since the token was never listed and that he had also burnt his Few. However, this wasn't a joke to some people as they actually ended up buying Few because of the influencer's promotional posts on Twitter. Others, seeing that Few wasn't listed on any exchange yet, tried to profit off of the hype by listing fake Few trading pairs on Uniswap in an effort to get some members to trade. The public may have moved on for now, seeing as how quickly trends come and go in crypto, but the Few incident had just confirmed and exposed what many of us had been suspecting for a long time. Yeah. Anything like this, you know, especially if they're not asking you to participate in it as like a node or a miner, I would hold it suspect. You know, I mean, I participated in the dissemination of a lot of coins, but you know, the thing is that the coins would get tipped to me, and then I would tip them to other people. You know, I mean, back in the day, there were bots in chat rooms that you could send some coins to pretty much everybody in the room from your wallet. And that kind of capability, it's really invaluable when it comes to getting the coins into enough hands for people to actually try using it as money. But yeah, this is an interesting little scam they were working in. Hopefully they didn't get away with too much money. But I kind of wanted to shift gears on that. And I keep telling you guys that it doesn't matter who the issuer is. It could be your next door neighbor's kid. It could be some major world renowned crypto influencer. It could be a developer of a project, or it could be a government. It doesn't matter what the entity is, or who the entity is, or what their qualifications are. They cannot assign a value to something for you. You know, when you're selling something or you're buying something with a medium of exchange, it's up to you how you value both sides of the equation. And so when it comes to things like CBDCs, where they're going to be telling you this thing is worth such and such an amount of monetary value, and you're to transact with it at that rate, and go fuck themselves. Anyway, this thing's on Cointelegraph. It's by Jack Martin. Consensus wins contract for Thailand-Hong Kong CBDC project. And let's reload this thing so we can figure out when it was authored. It was approximately 10 hours ago. And but this is by Jack Martin, so yes, penis. Blockchain firm Consensus announced September 25th that it had been awarded the contract for a cross-border payment project between Thailand and Hong Kong. The company will lead the second implementation phase of Project Ithanond Lion Rock. The project is a joint initiative to create a cross-border central bank digital currency, or CBDC, payment network between the banks in the two countries. Initiated in May 2019 by the Hong Kong Monetary Authority, or HKMA, and the Bank of Thailand, or BOT, the project announced the results of its initial research phase back in January. This found that there was significant potential to use DLT technology to reduce intermediaries and settlement layers in the current cross-border transfer process. The aim now is to build a proof of concept, setting up a cross-border corridor between Thailand's Ithanond and Hong Kong's Lion Rock networks. This will, of course, also require a solution for seamless currency conversion between the Thai baht and the Hong Kong dollar. Consensus will use its enterprise Ethereum stack technologies with focus on prioritizing scalability, security, and interoperability. The company has previous experience developing CBDC payment networks, having been involved in both Singapore Central Bank's Project Ubin and the South African Central Bank's Project Koka. More recently, Consensus was in the news after acquiring the JP Morgan developed blockchain project Quorum. Interesting. I gotta wonder who's backing Consensus. I'm sure the answer's out there somewhere. But yeah, I think that CBDCs ultimately will end up getting dumped as projects. We've seen a number of nation coins out there, and what they can never seem to do is force everybody to use their coin. Maduro hasn't even managed that, and he's been trying with the what do you call that? It's not the E-Bolivar, the Petro. You know, he released it a little while ago, and I'm sure that it's getting some use, but I would be willing to wager that crypto itself, Bitcoin itself, or Bitcoin or just altcoins in general, are probably being used at a much higher rate for things like remittances and even retail payments or retail commerce. So I think that in that light, CBDCs, they look great on paper. You know, they follow the same basic cues as the fiat currencies that nations currently circulate, which are basically IOUs to central banks. But they're meant to mimic that, as well as try and take advantage of some of the better things that we've learned in crypto about keeping records. The problem is that you cannot trust these entities to facilitate your transactions regardless of who you're transacting with. And most certainly not without taxing you at every possible juncture. And this is why they're going to end up losing to things like Dogecoin. Because they cannot possibly provide the same level of freedom, the same level of anonymity, and the security in your transactions with their CBDCs. You know, they can't even get banks to play the game straight at this point. So, you know, what's the hope that they're going to be able to create a token that will be 100% trustworthy, that they won't just be manipulating the relative value of behind the scenes. And, you know, it's all digital, so you don't have to carry it around in a wheelbarrow. But it'll probably be tied to a RFID chip, as they plan. And so escaping your debt would be impossible. Yeah. I don't really see these things as being the way that it's going to go. And it's really simple. You know, I saw something on Twitter, and it was about... Somebody was whining about 3D printers and 3D printed guns. And, you know, they're like, oh, we need to regulate 3D printers. Are you kidding me? There's all kinds of DIY projects out there on how to build one of your own. So, the idea that you're going to stop people from building them and then making things with them, it's fucking silliness. Complete and utter silliness. You know, I mean, people want to continue to have this mindset that, you know, we live in this 1950s world, and, you know, the average person can't have a fully operational machine shop in a small one car garage or 1.5 car garage. And we just don't live there. You know, you could have a shop that size milling and lathing parts for you pretty much all day long without much more than a little bit of cursory oversight by you. And all the technology to facilitate what I just said it's available now. It's in the public's hands now. So this idea that, you know, we're going to go from the average person having the productive capability of a warehouse full of machinery and whatnot in their garage, and we're going to have that as a reality, but rather than it going that way, we're going to do all of our shopping with Amazon. We're not going to invent anything. We're not going to create anything. It's all just going to be handed down to us from other people. And those other people will be, you know, Sony and Microsoft and Samsung and Apple and Monsanto or some shit like that. And like I said, these two realities, in my mind at least, are not possible. You know, the necessity for the average person to be growing more food, you know, for both themselves and retail commerce, and the productive capabilities being handed down to us from the wealth of the internet. It's incongruent with this ideal that's being pushed forward of a 21st century slavery or case system. Give me a fucking break. It's all about aptitude and attention at this point. Your willingness to invest in yourself. That's pretty much your only limitation at this point. You know, you could go on YouTube and you can get a professional understanding of something. It's like, you know, I watch a lot of videos on metal detecting. just by watching so many fucking videos on metal detecting, I can ID the difference between junk metals and gold when they're hitting it with their fucking metal detectors, because they all have the same relative frequencies. You know, it's like, oh yeah, that's a gold hit. And they dig it up, and sure enough, it's fucking gold. Now, I picked that up just by watching fucking videos of people scanning the ground with a goddamn metal detector. Who knows what else you could be picking up just by watching people do it on YouTube videos? Probably pretty much any fucking thing. You suck at math? Somebody has done a whiteboard segment, you know, where they're showing you every little function of the math and how to notate it and all. It's there. It's all out there. You know, so the idea that you're too stupid or that you're perpetually ignorant, no. That's just on you now. I mean, it was always on you, but it's so on you because the access to it is it's pretty much anywhere you can get the internet. If you can get access to the internet, it's there for you. If you know somebody who has access to the internet, they can download it to you. Download it and then sneaker net it over to your ass. The capability, the possibility is there. So, you know, I think that there's people out there who's it's in their interest to maintain this ideology that there's a disparity out there between peoples. That certain people are capable of certain things and other people aren't. That's all perceptual. And they have an interest in pushing forth this mimetic, in this realm, or not realm. It's like a semantic fog that they're imposing on you in the way that they're using their vocabulary that doesn't include this reality that you individually are capable of learning anything, are capable of doing anything, especially if you see somebody do it. If you see somebody else doing it, it's like you're learning so much just from the act. I mean, like, if you can imagine trying to do something completely cold, you know, you've never even seen anybody do it, you're just handed some equipment and say, hey man, figure it out, right? Can you imagine the differential in time that it would take you to figure it out? And I don't really care what it is, but to figure it out and to use it properly, can you estimate the differential in time it would take you to learn it without having seen anybody do it? Not even read a manual or anything. Just here's the hardware. Don't cut a finger off. Versus if you were to watch a YouTube video of somebody handling it. It's just quantum leaps. Just quantum leaps, man. Monkey see, monkey do. At least part of our imprinted expectation of like what the activity is. At least part of that is just going to save you months in just seeing it. You know, and I love that about jiu-jitsu. I get that tested in jiu-jitsu all the time where I'll get to see the instructor do it. And I say to myself, okay, I got to move my foot this way, I got to move my arm this way, I got to trap here, I got to grip there. But being able to see him do it, that shows me a great deal more than, you know, if I were reading like a book describing the movements and the exchanges and all that other stuff that I got to do on it. But that's the reality that we're living in now. We could be learning fucking aeronautics right now just watching YouTube videos. What the fuck are you doing, man? Anyway, let's go ahead and throw down with some music. And I'm feeling the need for some Skindred. And so here it is, Machine, here on Coin Metal. And that was Tool with Vicarious. And so, tell you what, there's a lot of busybody little bitches out there need to be smacked around for not paying attention to their own shit and getting up in other people's shit that it really ain't none of their fucking business. and I'm not being specific because the event has yet to fully shake out, so I have no idea what the totality of it is. All I can say is that some fucking people, it's like they can't stand other people being happy. It's like they see somebody being happy and, oh, we gotta bust you. No mask. No social distancing. I'm gonna bust you. Fuck you. Pay attention to your own shit. The people that are there are doing what they're doing, knowing the risks, and taking that risk anyway. And you know what? It's not you. It's not yours. And you have no business trying to make that decision for them. Anyway, back to what we're talking about. Came across this thing here, and I'm not entirely certain what the thesis is because I have not read all of it. I only read just a little snippet of it. I won't deny that the title of it kind of appealed to me just a little bit, but only because I'd always suspected this was the case, and it's kind of interesting to see somebody else come up with a thesis that may or may not relate at all to my own, but that conveys pretty much the same message. Anyway, so I got this thing here. It's on Medium. Why We May Fail Lightning. And this is by Antoine Riard. So yes, penis. And this is authored September 28th, 2020. No time or time zone. Shame on you, Antoine. Anyway, let's get on with it. A number of years have passed since I started contributing to Bitcoin protocol development. First on Rust-Lightning, then also on Bitcoin Core. I've been lucky to work on these projects full-time for the previous year, and it's a good opportunity to reflect on how Bitcoin is doing thus far. It is a frenzied and noisy environment, and at times you need to reflect and evaluate your roadmap for future Bitcoin contributions. Otherwise, you will quickly get lost and finish each day without making the desired progress. Let's get started by honestly looking into the Lightning infrastructure and then diving into the exciting fringes of Bitcoin and what the different Bitcoin tribes stand for today. It might help us to cast a light on the perpetual challenge of bringing Bitcoin to the masses. The state of the Lightning. Oh, and for one thing, Antoine, I'd just like to pause right there and say that that isn't yours to do. The masses need to come to Bitcoin. And we did initially, but people have made a habit of trying to drive us away so that they could be bringing Bitcoin to us. Well, fuck you. Anyway, continuing. The state of the Lightning Network. Lightning is considered as the flagship of Bitcoin innovation, and for good reason. A few years ago, it was just a wild dream on a whiteboard, and now you can interact with thousands of LN users around the world without caring about bank clearinghouses or segregated payment networks. That said, let's dig into the true state of its infrastructure. Lightning is binding to a blockchain as a judge model, namely, a set of transactions binding a contract between participants. In the case of misbehavior, the blockchain serves as a judge. The case will be adjudged using the plaintiff's cryptographic proofs. This is a completely different model than the first layer one. On the base layer, conditions of full nodes will protect your coins against miners misbehaving, assuming you're sharing the same consensus rules. On off-chain layers, other peers don't care about your counterparty misbehaving. The double spend problem within your channel is a private matter. This model presents a new class of attacks on your Lightning node. Your counterparty may try to burn in fees. What the fuck is that? Burn in fees your channel balance, or exploit the public nature of the base layer to block your channel close attempts, or leverage malleability to break the contract semantics, or directly attack your full node associated with your Lightning one. Further, your fee estimator also becomes a critical component for the safety of your funds. Holistic network behaviors like mass channel closing could break your security. It should also be remembered that Lightning keys are hot with all the challenges that presents. Sadly, most of the attack vectors laid out above are practical today. A subset of them are interdependencies with the base layer and the need to work at this level to be mitigated. We should remind that Bitcoin protocols won't be immune to DAO-like failures by the Holy Spirit of Satoshi. At this point, onboarding millions of users on the network is most likely to produce one of two outcomes. Either the whole network burns in flight due to a number of exploited securities issues, greatly impacting the long-term public confidence in the platform's trustworthiness, or after the first wave of serious attacks, network operators doubled down on requiring strong identification before any channel opening using the existing public key infrastructure. Thus, this grandly leads to centralization. None of these scenarios is appealing. Honestly, we would all be heartbroken if we were to end there after all our hard efforts. On the privacy side, things look better on paper. The fact is, we have to take a cross-layer approach, and it might not be as good as expected. For now, Lightning transaction format makes on-chain channel openings obvious. Balances are leaked for routing peers, which opens the door to traffic observance. A dearth of LSPs to initially peer with will compromise privacy. Receiver confidentiality is still a work in progress. Lightning privacy is definitively an area that requires more research before making any strong assertions on the level of privacy provided. Scalability presents its own concerns. The size of the UTXO set is going to be bottlenecked at some point. Cheap access to on-chain resources isn't guaranteed in the long term. The prospect of malicious congestion and spamming hasn't been addressed yet. Routing tables will likely be too large for mobile clients, hence they will need to delegate, decreasing their privacy. Removing the onlineness requirement for payments is still being worked on. I'm very confident that these challenges will be addressed in the long term, but in the short term they require considerable technological efforts. Step by step, we will make Lightning a robust, efficient, trustworthy financial platform. If you want to help us in these tasks, get involved with one of the brightest engineering communities. This is the right time to join the nascent stack of Bitcoin contract protocols. That said, narrowing exclusively Bitcoin innovations to Lightning, you will miss the forest for the trees. Other protocols that are being developed at the margins of Bitcoin are fascinating. As a side note, let's define a contract protocol as a wider scope rather than the off-chain one, as some of the steps can be played on-chain and thus even in optimistic scenarios. Vaults are the next step in key management. By combining multi-signature with time locks, they make coin custodial solutions far safer while enabling more fine-grained withdrawal operations. Further refinements will serve as building blocks for inheritance schemes or multi-stakeholder management. They're trying to distribute the risk amongst multiple shareholders, and that's not going to save them. That just means that more people's money is going to get burned at once. Anyway, discrete log contract are leading the way by bringing oracles in Bitcoin. By leveraging elliptic curve linearity, they make the betting contract unobservable by the oracle provider, only known by the participants posting collateral. They radically reduce the incentive to maliciously misreport the outcome. A future iteration will be to distribute them directly on Lightning as a new class of packets. One use case example is to let anyone hedge against their local currency devaluing. The biggest problem with any of these is that when you establish a contract, it does have an on-chain transaction that it's associated with that you will be paying at least part of the transaction fee for. When your contract tries to settle, though, it'll most likely be doing its own transaction. And in that case, you cannot guarantee the transaction fee at the time of the transaction to close the channel is going to be sufficient. The amount that you provide for that purpose, if it were not sufficient, you would not be able to close your contract out. Or even worse, if it became worth the entire value of the contract, you have the possibility of it becoming dusted. Anyway, continuing on. Let's see, Oracle provider radically reduced, blah, blah, blah. CoinSwap is the next iteration in privacy technology. By building on atomic swaps, they hide the exchange of coins from any blockchain observer. Their usage could become massive if they're used to context switch coins between different privacy domains, Lightning channels to cold storage. Payment pools are still at the whiteboard phase, but are promising in their attempt to combine confidentiality, scalability, and cost-effectiveness for future massive usage of off-chain protocols. What should not be underestimated is how these protocols are generating a measurable feedback loop that is improving the base layer. Off-chain or contract protocols require stronger blockchain assurances, including protection from certain network failures, whether they be accidental or malicious. As routing nodes earn fees by keeping their coins locked in channels, they lose money when transactions get stuck in mempools, and thus they are incentivized to pay more compelling fees, higher fees. By breaking a number of de-anonymization heuristics, these new protocols enhance coin fungibility. In addition, by providing access to financial services to parts of the world devoid of alternatives, they grow the Bitcoin user base in an ever more geographically distributed way. You know what? That doesn't mean shit. Is Visa decentralized? No. They serve like 1 billion people on planet Earth, but are they decentralized? No. Can you go to places that have limited financial services and still use a credit card? Yes. As a matter of fact, you could probably use a credit card anywhere on planet Earth where there's cell service. And so the same can be said for Bitcoin use. And this is a canard, it's a false concern. Devoid of alternatives? Give me a fucking break. If I've got access to the internet, I can do a Bitcoin transaction with anybody else that's got access to the internet. Continuing on. It's likely that each unit of usage of higher layer protocols will bring non-linear growth of value for the base layer. Layering private contracts on top of the public constitution will make the latter stronger. No, not necessarily. Trying to conflate two separate sets of values there. Anyway, continuing. The Bitcoin contract protocol stack is still in its infancy. We still have a number of frontiers to approach by combining applied cryptography, distributed systems, financial engineering, law practice, and game theory. In the future, this stack of contract protocols will gradually form the backbone of more Bitcoin-powered economies. They need to be matured sensibly with lessons learned from previous iterations. Yeah, that's a bunch of bullshit. It's like saying that Ethereum is like the test net for this type of scaling or this type of project, because that's basically what they're doing these days. But yeah, they still had the same issues with regard to fees. They get too high for the average person to pay. You've got to you would have to resort to having a third party pay them for you. Continuing on. The tribes of the Bitcoin stack. What might end up hindering our attempts to build a stronger Lightning and Bitcoin isn't any particular technical difficulty. That is something we will address with creativity, craftiness, and sweat, as per usual. When we look back at Bitcoin's short yet intense history, perhaps we should be more concerned with the risks presented from community disagreements. Said differently, the discrepancy between public excitement for Lightning and the state of infrastructure sounds like a cultural misalignment. No, it's really simple. It's fucking bankers. Bankers want Lightning, so they pump all kinds of bullshit about Lightning, and that generates your public excitement. Although, when people actually try and use it, and they run into all the little fees, and all the AML, and all the KYC, they just say no. Anyway, continuing on. If you have been to both a Bitcoin and Lightning conference, it's easy to observe divergent communities. Bitcoin conferences often focus on deep technical talks, prioritizing security and protocol engineering, and are attended by seasoned internet citizens, hackers of all sorts, and civil libertarians. After endless waves of scams, they are naturally skeptical, but intellectual debates remain open and honest. On the other side, the Lightning crowds feel different. Younger for sure, more startup-minded, and with talks focused on user experience and product design. Energy is flowing through the air, and you have to be 1,000 dazzling laps to play with. You can taste the Silicon Valley influence and easily recall that some participants were happily promoting their ICOs a few years ago. It is flashier too. The Lightning crowd does like a garish yellow and bright purple. That's a rough sketch, I guess. A lot of users are belonging to these tribes. At least I would confess so myself. Let's sketch these two tribes further. The LWN tribe. We have the OG tribe. They built the Bitcoin of today. Their determination, craftsmanship, intellectual rigor, and uncompromising ethics have built and saved the system from both technical and social attacks over the years. Not entirely. A good chunk of them are sharing a strong Unix background, and that's the best school of sound software engineering. You can appreciate the kinship between the major internet protocols and the Bitcoin ones. They both strive for simplicity. It is displaying the strengths of the wider open source movement, but we should also explore its weaknesses. Our kernels and compilers consist of millions of code lines, hindering their clear prehension. Our chips are closed and seemingly permanent security disaster, and we are too few considering the internet as a house for the curious mind. That is not to say the hard work of the previous years has been wasted, nor that we should give up our harshly conquered spaces of freedom, but we should have a clear understanding of the environment that is changing around us. Bitcoin fungibility is under attack, and it's going to worsen. Network-level disruptions should be anticipated. Block rewards are going to dwindle, and fees have to pay for a consistent network hash rate. Clumsily written code bases will hinder attempts to pass down hard-earned knowledge to younger Bitcoiners. And that's just a few of the challenges ahead. After you, someone needs to come in turn running the full node. Lightning and contract protocols are likely our best shots to continue the Bitcoin history in the brightest way. The Product Hunt Tribe. Then we have more startup-like tribes. They're talented at listening to users' needs, executing and serving those users. They make complexity intelligible by wrapping it inside attractive products. It is they who build the gateway to connect the outside world, which allows liquidity to flow in, all oiled with burn rate, ARR, and churn. But it is even easier to look at the failures of the startup movement. Funding cycles, startup bubbles, chasing extreme growth, and living in a constant state of urgency are good ingredients for delivering new digital products. But it is not a healthy environment when your main KPI should be optimizing the financial anatomy of your users, or autonomy rather. Admittedly, Bitcoin businesses are unique. The typical startup playbook doesn't apply here. Automatic updates and trust-minimized financial software don't merge well. Selling a security product and storing user data is quite an oxymoron. Offering nodes in the cloud whilst promising total financial control over your users is just a lie. If you require your users to trust you in any way, just say it plainly and bear the responsibility. Otherwise, you are deceiving when you use terms like privacy and trust minimization. Be ready to be scrutinized with the same rigor as when we are verifying our protocols. It's a worthy goal to reduce information asymmetrics, and we should aim for Bitcoin users to allocate their funds and time with the best knowledge available. Further, the current digital world has been built around the image of the passive user in mind. In Bitcoin, that translates into a user who can't rely on himself to manage his keys, won't be able to afford the fees for usage, and who is too narrow-minded to care about the behavior of the system. I dare you to do better. One should not forget that Bitcoin is first and foremost a tool for self-determination. If people fail to understand that, you're the teacher to blame. The truth is, you have real humans on the other side who strongly desire autonomy. One of the most magical experiences of Bitcoin is hanging out at meetups and observing people from all ages and backgrounds eager to learn. There is no fatality. If keys are too complex to handle, then we should roll out better designed key management solutions. If on-chain or off-chain fees are too high, we should craft better optimized protocols. And if the learning curve is too steep, we should produce better educational content. Failing to keep Lightning in consorts decentralized might be alright for base layer stability, but there is a non-zero risk of it backfiring. A decade from now, if a good chunk of the coin supply is allocated in channels operated by centralized services, even distributed base layer operators won't have much economical weight in the bargain to conserve consensus rules. We may wake up one morning and see them being broken in our plain sight, just as Bitcoin history warned us. Beyond the tribes, our living community. Bitcoin is a unique experience, and if we want to pursue it forward, we have to draw bridges between the divergent tribes. We need to learn all we can from each of them, but sincerely, we shouldn't bind to their past failures or accept outdated models. Due to personal ignorance, I'm only highlighting two of the Bitcoin tribes and their universes. A global picture would include 1,000 of others, like the Chinese mining community or the Venezuelan meshnet community. There is a Babel-like diversity in Bitcoin, and that's a force. We may spend more time fighting each other on social media on insignificant topics instead of solving common problems around a beer at a conference. And we might live in a more fragmented world, trapped within borders and without access to those high bandwidth events. It's a first-class necessity to maintain good communication interfaces between all stakeholders. We are all citizens of this Bitcoin Commonwealth. At least the SECP 256K1 curve is the same between BitDevs NYC, Berlin's Room 77, the Dakar Bitcoin Developers Meetup, and the Bitcoin Embassy TLV. What Bitcoin do you want to see? Bitcoin presents a fantastic game theory equation to align the long-term interests of all its players. Understanding and respecting its internal rules are the surest path to maximize wealth creation for everyone. But if we state the problem clearly, if we onboard millions of users in the same way as the internet, we are more likely to break Bitcoin than anything else. There is a fear about Bitcoin's future that it will not achieve as much as the internet, but honestly, what we should fear is not doing better than the internet. We aren't playing a zero-sum game, but we may be worried about some minority of its players, driven by the fear of missing opportunities, tapping into the wider majority's fear of never scaling to drive them against its own interests. Focusing on the adamant definition of onboarding as the only way forward, breaking the rules, giving up on past principles, and thus destroying the long-term value of Bitcoin. Looking forward, we can actively choose to onboard new Bitcoin citizens in our own sustainable terms, in a way which preserves the properties which have made the system successful so far. At our own pace, we have done so far servicing the human layer. A Bitcoin onboarding where you rely on an exhaustive set of resources in your native language to get started, where you have a great network of local meetups to learn from, where you have a wide set of easy-to-use tools to protect your digital estate, where you can positively interact with businesses on your own conditions, where you're always advancing forward on your personal quest for greater self-determination. Choosing this way, we're all going to be winners. Remind that empowered users will have a stronger economic activity. At term, this means more flourishing Bitcoin businesses and thriving economies. Zooming out, we should always remind ourselves that Bitcoin has its own temporality. Despite floods and riots, the happening did happen. Obviously, we are on the edge of a revolution, but coming from a continent which has experienced a bunch of them, the true story with revolutions is that most of the time they fail. As social and cultural changes are slow to unravel, it is tempting to lose patience and to burn to ground the foundations that have been laid out in a desperate attempt to fasten the process. For Bitcoin to turn into its full strength, it will take at least a generation, and we have to be ready for this outgrowth. Always remember that in the days of doubts, we have the choice between comfort and complacency, or freedom and adventure. We can't achieve a walled garden or a free jungle. Which one are you willing to build? Which one are you going to build? And I think we're almost done. We got one last little segment here. Hacking forward. Welcome those words with prudence. Don't take them for granted. Make your own opinion. Then act on your own definition of Bitcoin. As a friendly whisper, you've always been free to contribute. Meanwhile, as talk is cheaper than code, here's my promised personal roadmap. It is mostly continuing what I have been working on thus far. Number one, on the Bitcoin core side, there are 1,000 interesting things happening, Personally, I will be working on improving transaction relay and fee models for off-chain protocols, AltNet, to make it easier to deploy alternative transport communications, and hopefully addressing some of the off-chain security issues I previously referred to. Contributing to the Bitcoin core review process with a focus on refactoring and code modularity changes, as the health of the core code base is critical in the long term. On the Rust Lightning side, refining our cutting-edge features, adding more test coverage, and auditing the critical parts. Onboarding our new contributors, moving towards deployment. On top of it, scratching the wider Bitcoin development kit ecosystem with the awesome Square Crypto team. On a more research-oriented side, contributing to the discrete log contract specification, as the setup of reliable oracles will be such an exciting breakthrough. Thanks to the reviewers, thanks to Chaincone Labs for the last 12 months, thanks to John Pfeiffer for his confidence, and thanks to my fellow Bitcoin hackers from whom I'm learning so much every day. Have fun on this crazy Bitcoin ride. And let me see if there's any comments here. Looks like there's one response. Sober and well written. Yeah, I still think he's drunk on a couple things, but it's mostly this idea of scaling without increasing the size of the network, meaning serving more end users. And this guy taps on it a couple times. The difference in potential of a Bitcoin user versus just an internet user. But there's something he kind of leaves out there, in that back in like the mid and late 90s, the internet was just like Bitcoin, in that it was a bunch of free projects that you could work on and you can tinker with and you could fuck with, and you could gather with people all over the planet and fuck with them and mess with code and all that other that was all possible back then, on a much higher level than it's commonly taken place in today. Not to say that it's impossible, it's just not as many people do it. Not as high a percentage of the internet users out there do it. And that I think is to our discredit. You know, that if the average person knew how to mess with apps and stuff and use the code to the TCP/IP stack and all that other stuff, I think that the internet would be much better than it is today. That in some ways it's become kind of stultified, especially in the models that we use for designing software and layering. You know, that's one of the things that gives these guys all this idea that Bitcoin needs to have layers, is the OSI models. They want to rebuild Bitcoin to match like an OSI model. And the problem with that is that you are the network. Especially if you're hosting a miner, you are the network. If you're just hosting a node, you're still part of the network. You know, without you and without people like you, there is no network. There is no coin. There are no transactions. There's no Lightning Network. There's no payment channel without you. And see, they keep trying to change this about Bitcoin, that, you know, you can have it without being a part of it. And the problem with that is that as soon as you're not involved in it, but you're just using it, there is now a two-tiered system. The people that are running it, and the people that are using it. We already have systems like that. They're called like Visa and MasterCard and the SWIFT network. And Bitcoin was never intended to be that type of network. Anyway, let's go ahead and throw down with some music. And I'm feeling the need for some fucking Killing Joke. And so here it is. Loose Cannon. Here on Coin Metal. And that was Death Clock with Death Harmonic. Yeah, and we are coming around to the tail end of this thing. I was almost going to let it run for at least one more song, but I picked it up one too early. Oh well, these things happen. But yeah, we covered a lot of scammery. I did have one additional little bit of scammery that I wanted to cover, because this one seems kind of interesting to me. It's on Bitcoin, news.bitcoin.com. Tether's stablecoin dominance drops below 80%. As audit controversy lingers on. And this is by Terence Zamora. I guess this was authored 2 days ago. So yes, penis. The total volume of stablecoins in circulation is closing in on the $20 billion mark, while the market-leading coin USDT's share of the total circulating supply continues to shrink, data from Coinmetrics shows. According to the data, USDT now accounts for an estimated 80% of total supply, and the majority of the coins are now issued on Ethereum and Tron networks. Out of the total supply, the USDT-ETH accounted for approximately 53%, while USDT-TRX just took over 20% of USDT's total circulating supply. On the other hand, USDC, which has a market capitalization of $2.53 billion, according to markets.bitcoin.com, now constitutes 13% of the total circulating supply. The latest data, which was published on September 25th, appears to show that the continuing growth of stablecoin circulating supply, a trend similarly observed in a Coinmetrics report of July. According to that report, the circulating supply of stablecoins had doubled to $12 billion. Then, Coinmetrics attributed the growth to an investor practice of converting volatile crypto assets to stablecoins when markets crash. This practice was apparent in March of 2020 when the crypto market crashed alongside global stock markets. A global shortage of USD meant that many panicking investors were unable to move funds out of the cryptocurrency market quickly enough. Converting assets to stablecoins proved to be a useful option. The latest stablecoin growth appears to be a result of increased interest in DeFi, according to some experts. DeFi users reportedly use stablecoins to obtain high returns from various DeFi platforms. Meanwhile, a seemingly unprovoked attack on USDT, a stocks and cryptocurrency rating organization, Weiss Crypto Ratings, says USDC is preferred stablecoin because it is subjected to audits. I doubt that. In a post on Twitter made prior to Coinmetrics' latest data release, the rating agency asserts that, quote, unlike USDT, the USDC is subject to audits from at least 5 accounting firms. Based on these reports, USDC is more than 100% backed, which is why it is presently our preferred stablecoin. Yeah, what they don't bother to tell you is that it's backed by funds that are commingled from elsewhere in Goldman Sachs' balance sheet. Continuing on, or asset sheet rather. In another tweet, Weiss Crypto Ratings compares USDC to Tether, which argues it is not 100% backed. The rating agency repeats familiar allegations about Bitfinex's controversial vaults that, quote, are not publicly auditable. In a recommendation to its followers, Weiss Crypto says, quote, we recommend you avoid exposure to Tether. Interestingly, some Twitter users were quick to remind the rating company that auditing firms cannot always be trusted. One user asks, quote, well, but we know accounting firms are not to be trusted as well, or have you forgotten about Wirecard? None of the accounting firms involved discovered/reported the fraud. In the meantime, The continuing DeFi craze, as well as the high network fees on some blockchains, will likely cause further growth of stablecoin circulating supply. However, it is unclear if the growth rate will match that of earlier in the year. Yeah. And so what do you think of the latest stablecoin supply growth? Share your thoughts in the comments section below. Let me see if there is any comments on this. And there are no comments. Yeah, I think that basically what's going on is that they're stealing US dollars out of the cryptosphere by issuing USDC and USDT against them. And I've outlined how. And, with regard to USDC, they're probably doing the same thing that USDT does with Bitfinex, except they're doing it with Gemini. See, a lot of people don't know this, but the Gemini dollar is another stablecoin, and it too is backed by Goldman Sachs, in addition to the Winklevi, the Winklevoss twins. But the Winklevi, I don't know how much money they have either. And I believe that they've got Goldman Sachs managing it. And I've read something to that effect on this show. But that leads me to believe that Goldman Sachs is just as likely to be the central point of failure with regard to the liquidity behind, or the collateral behind, multiple stablecoins, not just one. I can directly connect them to at least two of them. And so, again, I believe that they're taking customers' long-term funds and using them as collateral for these coins, and to the extent that any collateral actually exists, and that whatever other collateral they have acquired or do have backing their stablecoin accounts is funds that have been directed to them by people buying USDC. That they don't actually have the collateral until you give it to them, and then they issue you USDC against that collateral. It's something to be concerned about. But how concerned to be, I couldn't really tell you. I think in the long term they're going to end up getting wrecked, and they're going to wreck some portion of the market in the process of that. But to what extent it'll contaminate the rest of the cryptosphere, well, only time will tell that one. And so it is with that I'd like to close out this episode. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Wednesday at 8 p.m. Pacific Standard Time. And so until then, I want you all to trade safe, do your homework, and watch out for your own bunghole, because nobody else is going to do it for you. And so as far as our last dance is concerned, I haven't picked one out yet. I am kind of working on that at the moment. I think we can get in some Metallica, though. It's been a little bit since we've played them. And so let's go ahead and go with Escape by Metallica, Last Dance, here on Coin Metal. Thank you again for listening, and y'all have an excellent evening. Good night.